Welcome to Episode 2.1 of Lumiq's Advisor Value Proposition. The Future to Holistic Wealth Management. In our previous video, we mentioned the beta and correlations between interest rates and bonds. Now, let's compare bonds versus stocks. As compared to stocks, which have a higher risk as it is based on expectations of whether the economy rises or falls. Dividends are ambiguous and share of profits are not guaranteed. Here we have a chart of different asset classes. Let's split the chart up into different sectors. As you can see, bonds have lesser risk and also lesser returns as compared to stocks. Generally, stocks have a higher risk which leads to higher returns. Hence, you can see the reason behind high risk high returns, low risk lower returns. When creating a portfolio, I'm concerned about the rate of return, risk of each investment and the correlation between the investment. How often do they go up in the same year? How much will they go down in the same year? In any given year, we found that the risk of one positive risk going up is offset by the negative risk of another going down. Hence, it is possible to have positive risks. If the positive risks and negative risks offsets each other, the portfolio may have a more optimized risk instead. What we have to consider are the kind of combinations with securities and correlations of each investment in order to find out what gives us the highest returns for the risk we're taking. Now, notice along this line that we call the efficient frontier. The portfolios are better than the alternatives, because it can achieve higher return with the same or lower risk. It is also better than just buying high-yield bonds because it has the same return but less risk. Rather than buying an inflation-protected bond, I can move up here and buy into a conservative portfolio. Not much difference in risks, but quite a big difference in returns. We can create a diversified conservative portfolio which has 80% in bonds and remaining 20% scattered to stocks. By doing this, what we're trying to achieve is a more efficient portfolio with the highest possible returns given the risk we are taking. What it means to create a beta portfolio and what's the advantage of that efficient portfolio versus single stock or single fund. Well, it's much more stable returns because you have some things that are winning and some things that are losing at any given year. It sets the expectation to your clients that some assets will underperform in any given year while others outperform. We don't expect every asset to be the outperformer every single year. That's part of what creates the stable returns. And you also set the expectation it'll take time for these benefits to be shown. Any single stock or fund can outperform in a year. But what about over a 5 or 10 year period? That's when the advantage of having a more stable portfolio really comes into view. The whole point of beta is trying to find what combinations of portfolios and asset classes gives us the best possible returns for the risk that we're taking. Essentially, as an advisor, timing the market is an uncertainty you should avoid. An example of the internet boom period: if you're right about the internet boom and purchase tech stocks, you might be up 515% for a short period of time. But, what if you were wrong? Or even missed the golden opportunity? If you have created and got into a beta portfolio, you'll continue to have a more stable and well-balanced portfolio. Well, now that's good that we have both alpha and beta covered. But we may be still lacking. Why is alpha and beta not sufficient? How do clients know if you're providing real value? For more holistic wealth management, check out the next episode on Gamma. Stay tuned to Episode 3. Lumiq's Advisor Value Proposition. Gamma.